Good morning, everyone. Welcome to the Macro Snapshot. We are Friday, September the 26th, 2025, recording this in the morning as always. Let's just see what's going on in the markets. Overnight, we had a little bit of tariff news. Basically, Trump has decided to, apparently from October the 1st, so only 4 or 5 days away, to impose tariffs on heavy trucks. So we've got a whole list here. Heavy trucks, which could really affect some of the German exporters like Daimler and companies like that. Kitchen cabinets, sort of bathroom cabinets, upholstered furniture, all of this kind of furniture and bathroom equipment coming in. And also maybe even more importantly, pharmaceuticals. So anything with a patent or a branded pharmaceuticals, he's threatened 100% tariffs. On the other products, we're talking about, sort of 50%, 30% tariffs. The language has been a little bit vague, so it's always difficult to know if that will, in fact, come into effect on October the 1st. But as you say here, you can see here, US to impose 50% tariff on kitchen cabinets, bathroom vanities, etc. So a bunch of new tariffs coming. And, at the margin, these are all very specific items, but it is always, incrementally adding to inflation pressures. In theory, anyway, and if they are imposed. So let's see how the market reacts to those. The other thing as well is that yesterday we had fairly strong data because it seems as though the GDP, the final reading, was actually revised upwards. You can see here this final reading, the third reading here from the second quarter, was revised upwards from 3.3 to 3.8. So that's a kind of a final number, which we have to imagine is relatively accurate. So that means that the US economy, is actually performing quite well, certainly better than had been the, in the numbers before. So that's a positive sign. But not only that, but you look at the personal consumption here, up from 1.7 to 2.5 revised upwards. And also a little bit concerning, and this is possibly an effect of the tariff push through on inflation. If you look through at some of the price indexes, they're also going up a little bit. So a little bit of inflationary pressures. On the other hand, we also saw yesterday the durable goods. Here you see everything pretty good. So if you look at capital goods orders, non-defense, which is like a core number, expected to come in at 0, actually came in positive. Some of the other subcomponents in the durable goods came in positive. And also, if you look at the initial jobless claims, remember we had that strange spike up to 260,000 a couple of weeks ago. But basically, yesterday we got 218, which is a very, very, very solid, labor market at this point. Initial jobless claims expected to be 233, so actually under that. And if we look at the 4-week moving average here, you see it's at 237, down below 240. So if someone dropped in from the planet Mars and said, "Oh, how's your labor market or employment situation?" you'd point to the initial jobless claims and say, "Well, it's fine. It's absolutely fine." And it's been that way for a long, long time. If you look at the continuing claims, again, that was slightly lower than expectations, 1.926 million. So, pretty good there. So the point is that yesterday the market took that, as a sign that the US economy and the labor market specifically, the employment market specifically, is fine. So we'll see in a second, but a lot of repricing happened, a lot of hawkish repricing. So we saw, actually, I'll just have a look at a couple of the charts here. So if we look at, let's say, something like the US dollar, we saw the US dollar continue to gain a little bit on that. Let's have a look at the dollar index here. So you can see the dollar just taking a bit of a pause now. But the dollar yesterday, so you had a bit of a push upwards, and continuing this sort of bounce off this sort of low, which we had, basically about a week ago, the 96.33. So it's now pushing up. It's above the 50-day moving average, pushing up to the 100-day EMA here. This is going to be a little bit more resistance. You see here, it should be, in theory, a little bit of overhead resistance here at 98 and 3/4. And we're just having a tiny pause now. So probably the next move in the US dollar will be determined by the data, which we get this morning in about an hour's time at 8:30. You can see in some of the other currencies here, if you look at the euro, you see the euro, basically a function of the US dollar strength here. You see the euro under a bit of pressure, euro itself now slipping under the 50-day moving average. Again, probably going to be data dependent. Another interesting one is the USD JPY. So you see the JPY here really softening a little bit. And it looks as though you see this trade range here, this little trade range, which we've had for the last 5 or 6 weeks or so, US dollar breaking out of that. Having said that, we are, so it's well above all of these sort of sideways moving averages here, above the 200 as well. But the thing here is you've got quite an important level which I'm just will extend out here. So you have quite an important level, which possibly you could argue it's sort of just above or just there, depending on how you want to sort of draw the crayons here. But essentially, this is looking quite good, 149. And you've got to say that maybe it wants to test up here, 150 and a half, 150 and three quarters, something up there. But again, could be dependent on the data today. The structural headwinds remain in force for the US dollar. But, in terms of positioning, like the market is massively positioned short. And so you have to say that, people here who are trying to short in this range, probably quite a lot of sort of market participants are being stopped out here. And the thing is that the yen was not helped because overnight, last night, we got the data out of Japan. We got the Tokyo CPI numbers, and the Tokyo CPI numbers were not only lower than last time, they were expected to be up at 2.8%. Now, keep in mind that the previous reading was 2.6, so expected to go from 2.6 up to 2.8, and actually came in at 2.5, so much lower than expectations and also lower than the prior reading. So, of course, that's in theory a negative for the yen, and that's probably helping the USD JPY go up. Talking about the data, well, we'll just look at yesterday's reaction. And so, as I say, on the back of that pretty strong data from the US yesterday, especially look at the short-term bonds here. You see here that the ZT, so the two-year bond yield, the two-year futures, down quite heavily. So really, since the Fed meeting on Wednesday, which is here, you see Wednesday the 17th, basically the front end has sort of been repricing, and essentially, that's on the back of the fact that Powell, on his speech in Rhode Island on Tuesday, was relatively equivocal, saying that for sure there are downside risks to employment, but there's also upside risks to inflation. And if we continue to get strong data like we saw yesterday morning, concerns still about sticky inflation, employment data, initial jobless claims was good. The market is pulling back from definitely pricing of 250 basis points cuts this year. And what is interesting is that we had a lot of Fed speak yesterday. We had, I think, 7 speakers from the Fed. There were a couple of people who were sort of saying that, for sure we should be sort of continuing to cut because there are dangers to the labor market, and inflation is not really an enormous problem. But I would say that overall, the tone was one of caution. The tone was one of, yep, sure, we're looking at the labor market, but we are definitely also looking at potential inflationary effects. And we don't believe inflation is slayed, basically. And so this is causing a lot of repricing at the front end of the curve, especially. And even if we go out, let's say, to the 30-year bond, not quite as much. So what you're seeing here is some bear flattening. And if we just look at the yield curve here, so if we go out to, let's say, the 2s, 30s, which is here, you can see here quite a lot of flattening. So you see pretty big flattening yesterday, and that's just the market essentially pricing in two things. Essentially, well, recalibrating the pricing, essentially saying that no need for the market to assume the Fed is going to be as dovish as had been thought. So less dovish pricing for the Fed, and also pricing in the fact that the real economy is doing quite well. Inflation is still sticky, so no need for long end bonds to collapse either. So it's just that the front end bonds are coming down more dramatically than the long end bonds here. So we're getting a bear flattening here, and then that's giving a little bit of a boost to the US dollar. What is interesting, if you look here at gold, despite the stronger US dollar, higher inflation, strong economy, gold, it's had a tiny little pullback here, but already you can see it looks as though this is going to be very shallow. And if anything, this looks, like another bull flag starting to come in here. And so gold, we all know that central banks are buying a lot. We know that even retail is buying a lot. Globally, there's definitely a sentiment of sort of a debasement of fiat currencies only backed by the goodwill of the governments, of course. And so it would not surprise me to see gold pushing higher. And you can see here that silver just absolutely having a ripper day yesterday, breaking out of this previous overhead, like historical resistance going back to 2011 at about $44 here. And you see just pushing higher. So at this point, I mean, look at all the moving averages here, just, going higher and higher and higher. Difficult to buy it at these levels, but certainly being supported. And that's possibly also, we know that the mine, we had that sort of cave in Indonesia, the Grasberg mine operated by Freeport-McMoRan. Now, keep in mind that produces about 3% globally of copper supplies. So 3% of global copper supplies come from that mine. That is offline, that is shut down. A lot of people are saying it's not going to be back online and fully productive back in 2027. So maybe another 18 months away or so. And so let's have a look at copper here. And you can see that copper, had a bit of on that news, had a push up coming down a little bit. But keep in mind that where copper is mined, often silver and gold is mined. So just incrementally, what happened at the Grasberg mine in Indonesia is, at least in sentiment, is probably going to help gold and silver as well. We'll see about copper. Okay, so let's just go back and look at the data for today. So as I say, we have some interesting data coming up today. And again, just to put in this perspective of how this could affect the Fed, I just want to show you something here. This is basically December pricing, so in the basis points. So you can see here that, essentially since the Fed it came out, obviously we had the cut, so that's just a mathematical 25 basis points here. But you can see since the Fed meeting here, the pricing has gone from about 45 basis points of cuts up to about 39. So just grinding its way higher, and this is the data released yesterday. So grinding its way, we still, almost have two cuts priced in. Let's have a quick look here and look at it. So you can see here that for the next meeting at the end of October, we have almost 22 basis points priced in 86%, but that was in the 90s. So that's definitely going down. And we can see by the end of the year that we have, actually, sorry, that's on the overnight interest rate swaps. We'll put it here. So it's 85% for the October meeting, and for December, just 1.5 cuts. 1.5 cuts is priced in. So about 40 basis points now. So definitely not 50. And I think that's going to be the situation. It's going to be data dependent. Something which I would say, though, which for me is quite interesting, if we actually look all the way out, let's look all the way out to, let's say, summer or September of 2026. Quite interesting here that if you're looking at something like June of 2026, only another 3 basis points are priced in. Three cuts are priced in, so about 75 basis points. So you see 77 divided by 25 basis points per cut gets you to 3. Now, here's my logic. If the economy deteriorates, and assuming the Fed cuts at least once this year, are we saying that the Fed will only cut another, once or twice by next June? I think this is a very interesting trade opportunity here. Basically, I think this is a little bit hawkish, especially for this contract here. The June one, maybe even July. It's very interesting here for me. Now, keep in mind as well that we do have a new Fed chairman coming in, or a chair, maybe it's a woman, a Fed chair coming in I think it's May. And so the point is here, we know Stephen Miran, we know what Trump is going to push for. Trump is going to push for someone, the new head of the Fed, the new chair of the Federal Reserve, who will absolutely cut interest rates by multiple times. And even Trump this morning saying that he wants interest rates, down to 1 or 2%. There's a huge amount of political pressure. And it seems to me that unlikely that by the middle of next year, and this is not even talking about a deteriorating economy or an economy which weakens, we are only going to get 3 cuts in the next sort of 9 months. So I think that's a very interesting opportunity there, in my personal opinion, that we shall see. Let's look at the data today. So in terms of the data today, we get some final readings of the University of Michigan. I don't think that's super important. Really, what we want to be looking at here is the personal income and spending. This personal income, is this going up? And more importantly, also, is the spending expected to remain stable at 0.5? Important number just to see whether the US consumer is feeling the pressure. Also, there's been a lot of talk that 50-60% of consumption in the US is actually just the top 10 or 20% of the population in terms of income percentiles. So it's just going to be interesting to see what shape overall the consumers in the US, especially with the spending and the real personal spending, which of course is adjusted for inflation. So really important set of numbers here. We also get the core PCE. So you want to be looking at the core PCE price index month over month, 0.2 expected to come in. So the market the consensus is for slightly softer numbers. You see the prior here, 0.3, expected to come in a little bit softer. And if we look at for the core, so let's keep an eye on that, because that in theory is the most important one for the Fed. So just in terms of the dollar, if the dollar comes in strong, sorry, if the personal spending comes in strong, I think that could be positive for the dollar. And I think in terms of equities, what they would probably prefer would be, relatively strong personal spending and whatnot, and a core index which is coming down. That's the sweet spot for equities. On the other hand, I think what we saw yesterday, and just going back to the equity chart, or actually going to the equity chart, is that on that strong data, interesting, are we at a point now where equities are not enjoying? You see the ES, the SP 500 futures coming off yesterday. If we look over at NASDAQ, you see down, I mean, not a huge, this is still no real technical damage. If we look at the Russell, you see that had, the biggest fall yesterday. So the Russell underperforming a little bit. So it does seem that the equities are very sensitive to, perceptions of where interest rates will be going. And so what the equity market would want to see today is a relatively solid consumer in conjunction with stable or stabilizing inflation or even lower inflation. And if we do get that, I expect that equities would probably be a buy the dip situation, at least on the short term. Okay, guys, so I think I'll leave it there for today. That's enough. As I say, we have that data at 8:30. Let's keep an eye out for that. And also maybe to try and get a bit more clarity on these new tariffs. So Trump suddenly seems to have decided that he wants new tariffs on certain products, kitchen cabinets. I guess he's done his renovations. Okay, take care. Have a great day, and we'll be talking again next week. Thank you.